Hello everyone, welcome to StudyIQ. So in this session, we will be talking about Urjit Patel committee. It is still relevant even though it was in 2014. So there can be questions which can be asked from 2014, this committee. Okay, because most of the recommendations are accepted, we'll be talking about all those recommendations. And then we will talk about Monetary Policy Committee, so MPC, and then we will discuss Monetary Policy Framework Agreement between Government of India and RBI. Okay, so first Urjit Patel Committee, then MPC, Monetary Policy Committee, then Monetary Policy Framework Agreement between RBI and the government. So this is how we are going to discuss. So far we have completed almost all the aspects of inflation. We have discussed about what is inflation, types of inflation, demand pull inflation, cost push inflation, the reasons for demand pull inflation and the cost push inflations, and the measures to take for demand pull inflation and cost push inflation. What are the expansionary measures? What are the contractionary measures? Okay, what are the monetary policy measures? What are the fiscal policy measures? And we have seen the related terms associated with inflation: stagflation, skewflation, the Phillips curve, misery index, throttling inflation, running inflation, galloping inflation, hyperinflation, inflation, disinflation, deflation, reflation, everything we have covered. And we have also discussed about the trends of inflation, where I've talked about over the last decade, the last 10-12 years, what happened, what was the trends of inflation, and we have compared it with the growth, what actually happened with the growth over this period. We have discussed about in different phases, what are the reasons for inflation, or what are the reasons why inflation has come down, what are the policies adopted by the government and the central bank. Everything we have covered. So this is going to be our last session on inflation. So let me start with Urjit Patel committee. Urjit Patel committee. So the name of the committee is Committee to Review and Strengthen the Monetary Policy Framework. Okay, so it is a committee to review and strengthen the monetary policy framework. So who was the chairman? Urjit Patel. Dr. Urjit Patel was the chairman. The report was in Jan 2014. So the report is about the changes which has to be made. So we will quickly discuss about the recommendations in the report. The first one, RBI should use CPI instead of WPI based inflation as a nominal anchor for monetary policy formulation. So when we discussed about the measurement of inflation, I've talked about WPI, I've talked about CPI. And when we discussed about WPI, I've told you it shows the impact on economy. So WPI shows impact on economy and CPI shows impact on the people. So which one is required to formulate the monetary policy formulation? Till 2014 it was WPI. So this committee recommended you shift to CPI because that will give you from the retailer point of view, the consumer perspective. Secondly, in WPI, one of the drawback, one of the disadvantages that services was not involved, right? So because services, there is no wholesale market for services, it is consumed directly. So there is no wholesale market. So actually this will give you partial production only. It shows only the production of goods. So it is not including the services. Thirdly, CPI is actually internationally best practice. So if most of the countries are doing with CPI for their monetary policy formulation, so we also shift to monetary policy formulation and it is accepted. And from 2014 onwards, we are using CPI as the anchor for monetary policy formulation. Okay, so RBI should adopt or use CPI instead of WPI as a nominal anchor for monetary policy formulation. It is accepted. So that is the first recommendation, most important recommendation. Now we are following CPI for monetary policy formulation. Second, RBI should endeavor to reduce CPI based inflation, from the current level of 10% to 8% within a year, that I'm talking about 2014 period, and further 6% to with 2 years, 6% to 2 years, that is by Jan 2016. This is not important for you at this point of time, but thereafter inflation should be maintained at 4% with a band of plus or minus 2 percentage point. Okay, so percentage point, you know what is percentage point? The difference between percentage point, the basis points, and the percentage we have done clearly in the monetary policy chapter or monetary system chapter. So now what is the ideal rate of inflation? 4%. We have discussed this many times, 4%, but there is a band that it can go up to 6 and it can come down to 2. So maintain between this 2 to 6. Okay, so there is a band which is given by the MPC. Then RBI should adopt flexible inflation targeting policy. So the prime objective of RBI should be inflation targeting rather than promoting growth. So I've told you there is a dilemma between growth and inflation, because if you try to control inflation, growth will come down, but RBI being part of government, RBI is also responsible to promote growth. So there is a dilemma, but that dilemma should not be there. Now your priority should be inflation targeting. Okay, so RBI or government should adopt flexible inflation targeting policy. Okay, then related to the fiscal deficit also, you have to reduce the fiscal deficit, that we have already discussed when we discussed about FRBM Act. Okay, so the government should reduce fiscal deficit to 3% of GDP to provide reasonable degree of flexibility to monetary policy. If you remember, in the last session I've told you, RBI in the third phase keep on increasing the interest rate. 13 times repo increased consistently, but government cannot control the fiscal stimulus because of political compulsions, right? You cannot withdraw the fiscal stimulus so easily. So only marginally you can withdraw because of political compulsions, political reasons are there. So what happened is the job or the objective or the responsibility of controlling inflation was solely became in the hands of RBI, and RBI have nothing to do apart from increasing the growth in interest rates, and RBI keep on increasing the policy rates, repo rate, and that resulted into a lot of problems, and that we have already discussed. So here the recommendation is, the government should also contribute towards the RBI's effort on the monetary policy, the contractionary monetary policy, by reducing the fiscal expenditure, or at least by following that FRBM Act, or reducing fiscal deficit to 3%. Okay, that is also accepted. So this is accepted, all recommendations are almost accepted. Next, monetary policy should be reviewed bi-monthly intervals instead of quarterly reviews. It is also accepted. Now it is after every month. Okay, next one, RBI should introduce a spectrum of term repos. Term repos means, actually this is similar to repos having larger maturity period. Like before it was 2 weeks, now it will be like 56 days. That means 8 weeks it was actually accepted. Okay, but the first initial repo, that is a repo of 2 weeks, will serve as the policy rate. Okay, and why? The reason for that is because interest rate for that will be slightly lesser, because it is for minimum days, 14 days. Here the interest rate will be more, so that will serve as the policy rate. Okay, that is repos of larger period was introduced, 8 weeks. Okay, but repo of 2 week will remain as the policy rate. Next point, the real policy rate should be positive. The real policy rate should be positive. So what do you mean by this? Actually, simple terms, repo rate should be more than inflation. Okay, see, nominal interest rate minus inflation is what your real interest rate. We have already done this. So repo rate should be higher than inflation, then only the real interest will be positive. See, if repo here, if it is lesser than inflation, what will happen? Real interest rate will be lesser. Then that will be a disadvantage, right? The lenders will lose and the borrowers will gain. We have discussed that with enough examples. Suppose you are lending 100 rupee. okay, and you are charging, let's say 10% interest, you are supposed to get how much? 110 rupee. But if there is an inflation of, let's say 12%, the items which you bought in the last year for 100 rupee, now if you need to buy, you need to pay 112 rupee, but you are getting 10 only. So had there been an interest of, let's say 15 you charged, then you would have got 115. So 15 minus this inflation rate 12, effective return will be 3, and this is what you call as the real rate of interest. So what you're effectively getting, this is nominal, 15 is nominal, but you need to adjust it with inflation to know whether it is correct or not. If you're charging 10, what is the problem? 10 minus 12, it is minus 2. You are actually losing here. Okay, so that is RBI has to control that. So because everything is related to the policy rate or the repo rate, so RBI have to maintain a positive or real interest rate should be real repo or policy rate should be positive. Next one is important. That is what we are supposed to discuss in the next topic. So monetary policy should be formulated by a 5-member monetary policy committee headed by RBI governor. So next we will discuss about this committee because it is accepted. So now we will be discussing about this monetary policy committee. Now whether this is accepted, real interest rate will be positive. This is to by and large accepted because there are problems with the government. Because see, if you need to accept this real interest rate need to be positive, means the repo should be higher. Repo should be higher means it is going to affect the growth drastically, right? Because investments will come down. But by and large it is accepted. So now we will be talking about what? This last recommendation, that is the monetary policy committee. So why this monetary policy committee? Monetary policy committee. So MPC. Earlier there was a technical advisory committee, and this will give advice to RBI governor, and RBI governor will take the final decisions upon the advice of technical advisory committee. It was not binding on the governor. Okay, governor can take his own decision. Governor can veto this advice, no problem. So here monetary policy committee is because now there is a voting. So in the committee there is a voting. So the committee will decide now. It is not the governor's sole authority to decide, the monetary policy framework. So the committee will decide this upon voting. Now, what are the benefits? Firstly, it is an international best practice. Okay. Secondly, it provides a wider perspective and diverse views. It will provide. Secondly, it will increase the transparency and accountability, because each and every minutes of the meeting, the committee meeting, is actually published, so people will be accountable. So it provides transparency and accountability. The minutes of the meetings are disclosed, so who said what, every details will be there, so people will be accountable, and it is more transparent also. It is actually relieving the RBI governor, and he don't want to face much problem from the political side. The political pressure is actually reduced for RBI governor, so good for RBI governor. And it also reduces the tussle or the drift between RBI governor and the government. Okay, so all these are the advantages. It will also promote coordination between monetary policy and fiscal policy. See, if you keep on increasing interest rates, if government is not going for fiscal stimulus reduction, then there will be of no use for increasing the interest rates, right? You increase the interest rate, at the same time RBI have to cut the fiscal stimulus. So fiscal policies also should be maintained as contractionary if you are following a contractionary monetary policy. So this will eventually can coordinate the monetary policies as well as the fiscal policies. So this is the advantages. Now what is the composition of MPC? So 6 members. So the first member is actually the governor of RBI. He'll be the head of the committee. So RBI governor, he is the head of the committee. Then deputy governor of RBI, so who is in charge of monetary policies? Actually there are 4 deputy governors are there. So one will be part of this, an officer of RBI, then one officer of RBI, usually director rank. Okay, so these three in the 6, and then apart from this, the rest of the 3 members are appointed by a search cum selection committee, headed by cabinet secretary. Okay, so and appointed for 4 years. They are appointed for 4 years, so that each members have 1 vote here, and decisions are taken on the basis of majority. Okay, so 6 members are there, majority means 4. So this is how the situation is going. Okay, now the question is whether the governor is having a veto vote here. Veto power is not there, so there is no veto to RBI governor, but there is a casting vote. RBI governor can go for a casting vote. Casting vote means in case of equality, like in the situation 3-3 situation, if it comes, then the RBI governor have a casting vote. Okay, and most important point here is the minutes of the meetings has to be disclosed after 14 days of the meeting, and then the government can convey its views to MPC through writing. So this is the composition. So RBI governor, deputy governor of RBI, who's in charge of monetary policy, officer of RBI, usually director rank, 3 members appointed by the search cum selection committee, headed by cabinet secretary. So then see, before Urjit Patel also recommended this, but Urjit Patel recommendation, the committee was like this. So under Urjit Patel there will be 5 members in the MPC, all from RBI. So how all from RBI is actually 3 from RBI directly and 2 appointed by RBI. So this is what the framework or the setup which was given by Urjit Patel related to the monetary policy committee, and there is no veto to RBI governor. So if you see here, 3 from RBI, now also there are 3 from RBI. Okay, but there 2 appointed by RBI, now that is not the case. 3 members are appointed by the different committee. Okay, no veto to RBI governor. Here also there is no veto to RBI governor. So this 3 is there, this is there, but this is not the case, and not 5 members, actually 6 members. FSLRC, Financial Sector Legislative Reform Commission, FSLRC also talked about this, and they have come up with a 7-member committee. Okay, 4 from RBI and 3 from government, and there will be a 1 non-voting member who is the nominee of government. So government can send a secretary to attend a meeting. Earlier, if you see, I've told you when we discuss about MPC, government can convey its opinion through writing, and instead of that, now you can send a secretary to attend the meeting, but he don't have any voting power. So here there will be a veto to RBI, veto allowed. But the proper reasons, the written explanation should be there why the governor is vetoing the majority. Okay, so you can see here no veto in the previous case here, and there is no veto actually here. Veto is given, but these 2 are not important. But some of the features from this is actually taken. Okay, and that's how this composition is like this. You just need to know this composition: 3 and 3. No veto, but there is a casting vote. Now we'll discuss about monetary policy framework agreement between Government of India and RBI. It was signed in Feb 2015, and it was included in RBI Act 1934 in 2016. Okay, so monetary policy framework agreement between the Government of India and RBI. So it was signed in Feb 2015 and included in RBI Act 1934 in 2016. So let me quickly discuss about the features. So features. So what is the prime objective of monetary policy? The prime objective of monetary policy is to stabilize the price, as we have discussed already in Urjit Patel committee. So that is accepted, I've told you at that time. So price stabilization is very important, or inflation targeting is very important, and this is what we called as flexible inflation targeting. Flexible inflation targeting means the priority is given to price stabilization, but at the same time you need to promote growth. Okay, so both has to be taken into consideration, but the priority is definitely the price control. Okay, price stabilization. So the prime objective of monetary policy is to maintain the price stability while keeping in mind the objective of growth. See, RBI is part of government. RBI should also contribute towards the promotion of growth as government, right? So this is what simple terms you call as inflation targeting or flexible inflation targeting. So flexible inflation targeting. Okay. So that is the first one. Then, so who will fix the inflation targeting? Government will fix in consultation with RBI every 5 years. So government in consultation with RBI will fix the inflation target once in every 5 years. Okay, so government fix in consultation with RBI the inflation target once in every 5 years. So what is the target now from 2016 to 2021? So I've told you already 16 it came into act. Okay, so 2016 to 21 the inflation targeting we have already discussed, that is 4%. So 4% and with a band of plus or minus 2 percentage point. Okay, so from August 2016 to March 2021, so government notified the target rate of inflation to 4% plus or minus 2 percentage points. So it can go from 2% to 6%. Beyond this, if inflation is going higher than 6 or lower than 2, then RBI have to take different measures, and otherwise also measures have to be taken, but written explanation has also to be given. Okay, so that is the next provision. Then RBI has to publish monetary policy report every 6 months. Monetary policy report every 6 months, including sources of inflation and forecast of inflation. Okay, so including sources and forecast of inflation. Forecast for how many months? 18 months, 1.5 years. Okay, so 18-month forecast should also be there in the monetary policy report. So RBI have to publish monetary policy report every 6 months, including sources and forecast of inflation for the next 18 months. Okay, then RBI will be deemed to fail in achieving the inflation target when, as I have told you, this situation, if lesser than 2 and more than 6. So RBI is deemed to fail in achieving the inflation target. So the target is what? 4% plus or minus 2%. So if it goes beyond less than 2 and more than 6, in this situation RBI is deemed to fail in achieving the inflation target for 3 consecutive quarters. For 3 consecutive quarters. Okay. Now, in case of failure, RBI have to submit a report to the government, which should indicate what is the reason why the inflation targeting is failed, or you are failed to achieve the inflation target. What are the measures that you're going to take, and the time framework, in which you can achieve the target. So these 3 should be mentioned in the report. Okay. So in case of failure, to achieve the inflation target, RBI have to submit a report. RBI report to Government of India or government, and which should indicate reason for failure, the measures proposed by RBI to achieve the target, and the time frame with which the target is expected to be achieved pursuant to such measures. So you are proposing some measures and how long it will take to achieve the inflation targeting. But what is the problem here? The flow, that most important problem here is, see, in developing countries, mostly it is cost push inflation. What is cost push inflation? It is because of supply side factors. And do you think monetary policies having much more to do with cost push inflation? Monetary policy can control only demand pull inflation. So monetary policy is having limitations in controlling cost push inflation, and predominantly the inflation is cost push. So RBI having too much limitation, and here you can see the government is putting complete responsibility or given complete responsibility to RBI to control inflation, and RBI will be blamed if inflation target is not achieved. But the problem is cost push inflation, and government can do much more than what RBI can do with respect to cost push inflation. So that is actually the flow of the problem with this monetary policy framework agreement. Now what is inflation targeting? Inflation targeting means, as I have told you, you just need to understand the word inflation targeting and flexible inflation targeting. Inflation targeting, we have already told that RBI will give importance to price stabilization or target inflation. That is what inflation targeting. Flexible inflation targeting means you will try to control inflation, at the same time you have to promote growth. Okay, and here it is mentioned that flexible inflation targeting, that means control inflation at the same time promote growth also. So what are the advantages for this? Advantages here, we'll discuss about advantages. Mostly we need to discuss about disadvantages, because critically evaluate will be the question. So advantages: it increases the accountability of central bank, increases the accountability because it clearly defines what is the objective of monetary policy and what is expected from monetary policy. Secondly, it increases sensitivity of government as well as central bank to control inflation. The reason is the inflation target is there, so you have to achieve the inflation target, otherwise you have to give the reasons, you have to take measures, you have to give the time frame and everything. So it is better to control inflation, so it will make more, it becomes more sensitive. Okay, so it increases sensitivity of government and RBI in controlling inflation. Okay, thirdly, it reduces the tussle between central bank and government of India. If you remember, in the previous session I have told you that repo was increased 13 times during that third phase of inflation, when we discussed about trends of inflation. So RBI and central government and RBI came in tussle each other, because government want to reduce the rate, but RBI focusing on inflation targeting and kept on increasing the repo rate, and that led to problems. So these are the advantages with respect to this when you are fixing the inflation target. What are the disadvantages? See, disadvantages most importantly I have told you already, the monetary policies are least effective in controlling cost push inflation. But in developing countries, the inflation is actually because of cost push inflation, because supply is inelastic. In developed countries, supply is elastic, so there is no chance of inflation over there because of elastic supply. Here it is inelastic, supply is not enough. Okay, so less supply and cost of production is also high in developing countries. So problem is with supply, so cost push inflation is maximum. So you have nothing to do with demand here. Maybe if it is demand pull inflation, you can control with monetary policies, already. So here the problem is with supply, so cost push inflation. There is a limitation for monetary policy to control cost push inflation. So here you are talking about monetary policy. So what you will do is basically to control inflation. See, this is the situation, right? This is a normal situation. When you regulate the economy, so this is aggregate demand, this is aggregate supply. So when you go for, the monetary policies, you will increase the reserve requirement and you will, increase the interest rates. So what will happen? The investment will come down, growth will come down, automatically supply will also come down, investment come down. So that again lead to inflation. You can see here the price is actually increasing. The price level, you can see here price is increasing. Even if you are taking monetary policy measures that is affecting the investment, that will reduce the supply, that will increase inflation further. So monetary policies have less to do with inflation in developing countries. So such policies are not desirable in developing countries. In developed countries it is okay, because developed countries inflation is because of lack of demand, so you can do those kinds of things, but developing countries it is not desirable. So I hope you understood this. If you have any doubt, you can get in touch with me here. This is my Instagram ID, and you join the Telegram channel for all my videos. So we have done everything related to inflation. We have discussed about what is inflation. Okay, we have discussed types of inflation. We have discussed demand pull. We have discussed cost push. Then we have discussed about the reasons, and then we have discussed the measures to control inflation. We have discussed about the measurement of inflation. There we have discussed about WPI, we have discussed about CPI, we have discussed about 10 CPIs, we have discussed about producers price index, we have discussed about service price index, all those things we have done. And then we have seen the types of inflation. Okay, inflation, disinflation, reflation, deflation, skewflation, stagflation, Phillips curve, misery index, all those things we have discussed. The throttling inflation, hyperinflation, galloping inflation, running inflation. Okay, and then we have discussed trends in inflation. And then we have discussed Urjit Patel committee, and then we have discussed monetary policy committee, and then we have discussed about the agreement, the monetary policy framework agreement between RBI and Government of India. Okay, so that's it. We will be starting with new module in the next session. So we'll be starting with agriculture. Okay.